In today's video, we're going to talk about something that most people in crypto don't want to hear right now. As the crypto market starts heating up again, prices are moving, sentiment is shifting, and suddenly everyone believes the next big rally has already started. But what if this move isn't the beginning of a bull run at all? What if the crypto market right now is quietly trapping retail investors, just like it has in every previous cycle? Because every time crypto starts to move, retail investors rush in chasing confirmation, while smart money is already positioned. And by the time retail feels confident enough to buy, the trap is already set. Today, we're breaking down how the crypto market traps retail investors, why it keeps happening, and what signals show that retail is being used as exit liquidity once again. We've got a lot to cover in this video, so I'll keep the intro short. But if you find any value in this content, can I ask you to smash the like button? It takes a lot of time to make these videos, but it literally takes 2 seconds and costs nothing to hit like. And it helps the channel more than you think. I'm aiming for 500 likes on this video, so help me hit that goal. Subscribe to the channel if you're new and turn on notifications so you don't miss videos like this. And as always, I am not a financial advisor and this is not financial advice. Please do your own research. I'd also appreciate it if you try to answer the question I'll ask later in the video. Now let's get into it. What does it mean when we say the market is trapping retail? The crypto market doesn't trap retail investors by accident. It does it through structure, psychology, and timing. Retail investors are conditioned to wait for confirmation, higher prices, bullish headlines, influencer validation. But confirmation usually comes after smart money has already made its move. Every cycle, retail buys strength. Smart money buys weakness. When price starts to move up after a long downtrend, institutions and whales are already holding positions. Retail investors, on the other hand, wait until price looks safe. That delay is where the trap begins. The retail investor playbook and why it fails. Retail investors tend to follow the same pattern. They wait for price to break resistance. They wait for social media sentiment to turn bullish. They wait for YouTube thumbnails and Twitter threads to confirm their bias. Once that happens, retail piles in, often using leverage, believing the rally has just started. But in reality, this is usually the phase where smart money begins distributing. This isn't manipulation. This is market mechanics. How smart money sets the trap. Smart money accumulates quietly when sentiment is negative, volume is low, retail interest is gone, and price slowly moves up. Nothing explosive. Just enough to spark curiosity. Once retail interest returns, volatility increases. Breakouts appear. Influencers turn bullish. Retail confidence rises. That's when the trap closes. Smart money doesn't dump everything at once. They distribute slowly while retail continues buying higher prices, convinced this time is different. On-chain signals show retail is late. When retail is trapped, on-chain data usually tells the real story. We often see increased exchange inflows, long-term holders reducing exposure, whale wallets moving coins to exchanges, funding rates turning aggressively positive. These are not signs of accumulation. These are signs of distribution. Yet retail ignores this data because price action feels bullish. Why this keeps happening every cycle? Retail investors are emotional participants in a market dominated by unemotional capital. Fear of missing out pushes people to buy late. Hope convinces them to hold through drawdowns. Panic forces them to sell at the bottom. Smart money understands this psychology and positions accordingly. The market doesn't need to trick retail. Retail traps itself by reacting instead of preparing. Bull market narratives are the perfect trap. The most dangerous time for retail investors is not during bear markets. It's during early optimism phases. This is when bull market confirmed narratives appear. But even in real bull markets, there are brutal pullbacks designed to reset leverage, shake out weak hands, transfer coins from retail to institutions. Retail assumes price only goes up. Smart money assumes volatility. Infrastructure and utility versus retail speculation. Another major difference between retail and smart money is focus. Retail chases price. Smart money builds exposure to infrastructure, utility, and ecosystems. Retail looks for quick wins. Smart money looks for long-term positioning. This is why retail keeps getting trapped while institutions quietly grow their positions cycle after cycle. What retail investors should be asking instead of asking, how high can price go? Retail should be asking, who is buying right now? Who is selling? Is sentiment overheated? Am I early or am I exit liquidity? When everyone is confident, risk is high. When nobody cares, opportunity exists. What happens next? As crypto continues to heat up, these traps will become more frequent. Volatility will increase. Narratives will shift rapidly. Retail participation will rise, and so will liquidation events. Those who chase confirmation will struggle. Those who understand market structure will survive. This cycle will be no different from the last, only faster. So let me ask you this. Do you think the crypto market is starting a new bull run or setting another trap for retail investors? Drop your thoughts in the comments below. I read every single one. If you enjoyed this video, make sure to like and subscribe, and check out the other videos appearing on the screen right now. Have a great day, and I'll catch you in the next one.